All right, I am live. Hey, everybody. It is Chuck Barone, Thursday, May the 23rd, this month going by like a blink of an eye. Glad to be here on a Thursday. See all my friends on the live chat. How you guys all doing? Ghazi on today, Salty, Wolf, my man. Of course, Attila, Kevin, a lot of our regulars. Nice to see you guys on board. And yeah, he did sell his Vegas place. I helped him when he bought it, and my real estate friend Jordan helped Greg out when he sold his place here. I wish he was still in town, man. He was a great friend, and I miss him here in Vegas. Anyway, I digress. Sorry, reading the live chat there. Um, Before I get rolling on the show today, we got a lot to talk about. Just want to, as always, welcome everybody to the show, and thank you guys for your support. You guys being here, all your comments and questions, all my regulars. I really appreciate all of you guys and the support you give the channel every day. All right, so let's talk about markets today. Let's talk about what the heck we're looking at. Hey, Donna. Um, so the market, yesterday Fed minutes came out, and it was kind of just a quick glance over. I looked at it. Really, in my estimation, didn't really say anything different than what we've been talking about. The Fed is understandably disappointed with the way inflation is coming down and being stalled out where it is. They are talking about keeping rates higher for longer, which they've been doing forever. Okay, the couple of little changes that they did make, they're talking about the tapering, where they're going to not pull 95 billion a month out. They're going to cut it back down to about 60 billion. And there was some dissension there, some discussion about that. What's interesting, and I'm going to talk about it a little bit later, the Fed now is changing the way they're thinking about inflation. They've been pretty strong in what they've been saying. They've had the same message going forward. Inflation's coming down. We're going to keep rates restrictive as long as we need to, blah, 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 blah. That's where they've been. Well, now they're going to change that around a little bit. We'll talk about that. But first, let's go through this markets today. So the market reflecting on these Fed minutes, deciding they did not really like the message in those Fed minutes. So the stock market today, in spite of NVIDIA's amazing news, the Dow completely tanks out, minus 605 points, dropping to 39,065. The NASDAQ falls 65 points, 16,736 on the NASDAQ. S&P falls 39 points, 5267 on the S&P 500. So across the board, stocks tanking today. I think everybody understanding stocks are a little bit overpriced. PE is super high. This bullish sentiment on the stock market, I mean, it makes sense. Companies are still earning. The S&P 500 creating way more 52-week highs and 52-week lows. But there comes a point where if you're putting real money into this market, you have to kind of look at this and say, well, what are my chances for a real return here? I think we're heading toward the end of this bull cycle, not in the beginning or the middle. So, you be cautious investing in the stock market these days. The bond market also had a tanky day, crap day. Yields rising. The 10-year up 5 basis points, sitting at 4.48%. The 2-year up 7 basis points, 4.94%. So now the bond market's starting to react. 2-year heading back up toward 5. Boy, that was fast, right? And the bond market moving back to being priced probably where it should be. I guess the last $16 billion Treasury auction was not a slam dunk. So, remember, guys, it's not only the Federal Reserve that's going to set these interest rates. They can only do one thing. They can change the overnight rate, which obviously affects every other rate going forward. But when you've got an inverted yield curve for 2 years, when you've got a federal government borrowing money at the pace never seen before in the history of the world, all of that is going to affect rates, guys. Okay? And it is. I mean, the Treasury alone, the way they're selling bonds, is going to be enough to move rates higher, especially with no jawboning from the Fed about lowering rates. So just keep that in mind, guys. The dollar today rallies up 13 basis points, back up over 105, 105.04 on the index. I think really fair value for the Dow the way we are is around 106 on the dollar index. I would not be surprised to see it get back up to that. But the stronger dollar, all this sentiment about rates, terrible for gold and silver today, giving back a nice chunk. Gold falling $48.60, still at $22,330.40. Silver falling 62 cents at $30.06 per ounce. Now, guys, it's disappointing to see these numbers coming down. It really is. But this gives us a chance to maybe look at buying, if the dip continues, to look at buying, adding to the portfolio, buying a little more gold, a little more silver. I really like silver. I'm telling you guys, it's going to be 35 soon. And I believe that, buying right now is a pretty good opportunity for a pretty hefty, 15% return in a short period. Now, the thing with gold and silver that's always my bane of gold and silver is the juice these dealers charge you buying in and getting out. So make sure there's a little bit of room in there for profit for you in between profit for the dealer. Oil falls today 70 cents, $76.87 for a barrel of West Texas Intermediate. Exactly what I've been telling you guys. It's going to get back down into that trough between 70 and 75. That seems to be where it's most comfortable. It's on its way back down there now, although there is some resistance dipping below 75. Bitcoin today falls down $1,626, 67,770. It's really interesting to me. I've been watching Bitcoin now a little bit more closely, and it seems to be mirroring the Dow Jones. It's very strange. When the Dow has a big up day, it certainly seems to me like Bitcoin follows right up. When the Dow Jones has a terrible day, Bitcoin follows and has a terrible day too. It's very strange. I'm going to try to find out, do some research to see what the linkage is between these two. It's very strange that they seem to be moving in tandem like this. All right, let's talk about these Fed minutes, because that's what spooked this market today. Now, the minutes showed that the Federal Reserve governors are dissatisfied right now with the pace of inflation coming back down. So now they're moving from, they also disagreed on the tapering. Yeah, there were several Fed governors who did not want to change the tapering on that QT, did not want to cut it back down. Some governors felt like the tapering was too much. So they've got some disagreement there. The minutes show that the Fed is dropping now what has been kind of specific guidance. And now they're moving more to, this is great, guys. Now they're talking scenario analysis, right? This is something different. We're talking about different scenarios. Inflation spikes back up. Inflation stays where it is. What do we do with this? What do we do with this? So now you can see the real uncertainty in the Federal Reserve. More Fed governors than I've seen in a while talking about the possibility that rates where they are not restrictive enough to bring that down back to 2% inflation. Really, really interesting stuff. They show that the uncertainty. They came out and explicitly changed the messaging. Markets are going to freak out, guys. Imagine if Powell or Waller, because we're going to have Waller on tap tomorrow, any of these Fed people actually came out and started talking about the possibility of raising rates. Instead of the dialogue all has been, when will rate cuts start? Now we're going to change the direction of that a little bit, more neutral, and the market swaps, comes right in. Now they're seeing the first rate cut. Guess what? Just what I've been saying all along, in December. There's still some sentiment about November, but December seems to be the month the market's settling on for the first rate cut. I'll tell you guys again, as I've been telling you before, we're lucky if we get that rate cut in December. These numbers are horrible, really, man. I mean, let's look at it. Inflation, was coming down. We were watching it come down every single month. Well, it seems like it's been kind of stalled this entire year, right? about 3.5%, stubbornly not move. It moves down a tick, but then it moves back up a tick. So the market's really starting to get impatient because, as you guys know, we've been talking about ad nauseum, right? Um, the market is just drooling, foaming at the mouth for these rate cuts. And we've also talked about why. I mean, really, I guess if you're a big corporate borrower borrowing millions and millions and millions of dollars, okay, a quarter point means something to you. If you're one of us, working people, schmuckatellis, a quarter point cut, other than the mental, the psychological benefit you get from rate cuts, it's certainly not going to change anybody's lifestyle, right, guys? So it's just silliness. And now the Fed coming around to reality. I got to see what Waller has to say tomorrow because I guess he's going to be the guy out front. So we'll be looking at that to see what the comments are. And I tell you right now, there's going to be a change in the tone that these governors are talking about. We got jobless claims today. Jobless claims coming in lower than expected. Market expecting 220,000 claims. They got 215,000. Shows the job market's still strong, even though the jobs are not the greatest jobs. They're certainly not the $50 an hour jobs, but jobs are out there for people who want them. And here you have it. So jobs, this is another nail in this rate cut coffin because these jobs, it spiked up a little bit in the 230s, right? Everybody was like, ooh, maybe. No, 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 no. Looks like it's coming right back down so the market stays warm. Walmart and Target, they came out with earnings yesterday. Did you see what happened at Target? Fourth straight quarter of crap earnings. Guys, these are the stores, Target, Walmart, these are the stores that regular people do their shopping at, okay? Most regular middle class people are not shopping at Neiman's or Saks. They're not going to Ferragamo for their shoes. These are Walmart, normal, regular consumers. And the sales numbers at both of these places showing the consumers tapped out, man. There's really not even any room left for, what do they call it, discretionary spending. That's gone. It's only necessities now. The rich having their way because this is a big only inconvenience to them. It's not like choosing between my power bill and my prescriptions, which is what's happening to regular working people. That's where the plastic's coming in, guys. People making up the difference by borrowing the money. It's just a disaster coming. And you're going to see some big old bankruptcies coming around once the smoke clears a little bit and people are looking at their debt. They're looking at the reality of that debt. Are they going to be able to ever pay it off? When you see that come, you're going to see bankruptcies spike. Home sales. God, guys, I've been telling you the state of the real estate market for a long time. It is just absolute dog shit. There's nobody wanting to buy a house. Would you? I mean, even if you could get a great deal on a house, right? You could buy a $450,000 valued house for $400K, pick up 50 grand in free equity. Would you do it if it came with a payment of $3,000 a month? The answer seems to be no. Price is actually starting to fall. The median price coming down nationally, down $6,000 this past month. Builders now cutting prices, going back to their incentive-based stuff where they're buying rates down for people. We'll give you the free granite countertops. We'll give you the free appliances and all these different, incentives to get people to even come and look at these houses. I don't know, guys. I mean, even the Fed cuts rates. Let's just say the Fed gets real busy, cuts rates. Before the end of the year, they cut rates a half a point. Okay, that would bring the mortgage rate down to 6.5. Now that's going to be helpful, but it's certainly not going to cure the market. This real estate market is not going to recover at all until you see mortgage rates about 5.5%. Here's the problem with that. As soon as rates get anywhere near desirable, you're going to see a stampede of people into the market. That's going to switch all of it back to a seller's market. You're going to see the madness we saw in 22, people buying houses above appraised value, waiving inspections, waiving all kind of their own protections. you're going to see, house prices spike up to fill in the difference. I mean, sellers are not stupid people, and typically neither are their agents, although some of them are a little less professional than others. Um, so, this real estate market is just going to be screwed up for a long, long time going forward. Jamie Dimon back in the news today, warning again about a hard landing in stagflation. He keeps pointing to the inflation numbers and the warnings he's been given all along about how hard it was going to be to get back to 2%. He certainly seems to be on the right side of things, at least so far. Not one of my favorites, but a pretty bright guy, we have to all admit. He's talking about stagflation, the worst of all worlds, talking about high unemployment and unemployment spiking up from where it is now around 3.8, 3.9% into the sixes, even sevens. At the same time, you still have the sticky inflation and high rates. The worst of all worlds, a revisit of the late 70s and early 80s. Dimon's a pretty bright guy. Hopefully, he's wrong on this one, right? We got a new trade war brewing. Interesting stuff here now, right? Used to be competing with China over stuff, basically, who's going to sell the steel, who's going to sell the washers and dryers. Now it's all about supply chains and tightening up your supply chain so there's no breakdowns there, which cause prices to spike. And all the big fighting now, minerals and metals. This is where everybody's going. This is what now going to be moving these markets. Metals, minerals, these are things that we need for this battery-powered society we're going to be running on. China kicking everybody's ass in that regard, guys. They've been locking up minerals all over the world for years. America finally waking up to it. Luckily, we have Canada up north to us, who's like in a mineral and basic resource-rich environment. Maybe the government isn't smart enough to figure this out for themselves. Maybe they'll listen to me. Cut a deal with Canada, dipshits. Let's get what we need. Let's see, what else do we got? Oh, yeah, if you see United Wholesale Mortgage today comes out with a new 0% down payment program. Oh, yeah, it's a zero down payment, all right. What they're going to do is give you a silent second mortgage for up to $15,000 to use as a down payment. Is that money free? No. It goes on your credit. You don't have to make a payment. There's no interest accruing. But that $15,000 sits there. And as soon as you decide you want to refinance or sell that house, that $15,000 becomes due and payable. So basically, it's a short-term, it's a loan, an interest-free loan to use as a down payment. I just don't know if that's going to be, enough to pick this market up. I seriously, seriously doubt it. Let's see what else. Oh yeah, Fed minutes now affecting gold and silver prices, guys. When the Fed is talking about possibly raising rates, you saw what it did to the dollar today, the dollar picking back up. Stronger dollar, typically bad news for gold and silver. That's not the only reason. You still have profit taking. You still have some uncertainty in the markets on gold and silver. But one of the drivers of this little decline here over the past few days are these Fed minutes. Crazy times, guys. I tell you, it just keeps getting crazier every day. But we will bring this show tomorrow. We'll wrap up this crazy, funky week. The big news tomorrow is going to be consumer sentiment. It's going to be interesting to see what that says, how consumers are feeling about inflation. We talked yesterday on the show about the weirdness where, so many people believe we're in a recession. They believe the stock market's cratering. 60% of the people they polled think that joblessness is at a 50-year high, guys. So people not really in touch with what's happening, right? So it'll be interesting to see how that reflects on the consumer sentiment we get tomorrow. It's going to be a fascinating day. Anyway, I've been rambling on. It's going on almost 20 minutes, guys. I appreciate everybody be here. Zoot. Look at Zoot on there. All right. Salty, of course, Kevin, Donna, all the regulars on the chat. Keep it going, guys. I appreciate that. Don't forget to hit the like button, guys. Hit that thumbs up. It changes the algorithms around. It gets our video out there in front of a few more people. I'll be on the comments today, going back and forth with you guys. Always fun talking with you guys on there. And we'll be back tomorrow to bring you the news you need. Until then, everybody, take care. Thanks.